Welcome, everybody. Good morning, good afternoon, or good evening, wherever you are. I'm Jos Plumire, Director of Infrastructure at GRESB. For those who aren't familiar with GRESB, we offer an ESG reporting solution. We evaluate, score, and benchmark the ESG performance of real assets, as well as providing a way to share data and insights between assets, funds, investors, and other stakeholders. So today it's great to have so many people join us at this GRESB Inside ESG event on the GIH Monitor Report, which we're also pleased to be holding in collaboration and in partnership with the Global Infrastructure Hub. We're excited to say that this event is also being held in the run-up to the publication of an ESG supplement to GIH's Infrastructure Monitor Report, which will be published soon and you'll hear more about today. This short report is an ongoing collaboration between GIH and GRESB as we look to combine GRESB's data insights with GIH's wider reach and remit to provide in-depth analysis of global infrastructure and to present those insights to help policymakers, investors, and others steer a course towards a more sustainable, resilient, and inclusive infrastructure future. So, without further delay, we'll get into the event today that everyone is here for. We'll broadly split this event into two parts. Firstly, we're going to have two short presentations from GRESB and GIH before we move into a panel discussion. And we've got some great speakers today working in sustainable investment in infrastructure. So I'm sure we're going to have some excellent insights. So without any further delay, I will introduce the first speaker, and that will be Fabio Schweinoster-Manfroni, who's an analyst in the GRESB infrastructure team. Fabio is going to do a bit of a deep dive into the GRESB results from 2022 and draw out some key insights before we move on to some more specific insights around the GIH report that will be published shortly. So with that, it's over to you, Fabio.
Thank you so much, Jos, and thanks everybody for joining today. Well, in this session, I will indeed briefly introduce you about GRESB, what is GRESB and what we do at GRESB. Then we will look a bit at the coverage data and the benchmark composition right now. And afterwards, we are also going to look at the actual performances of infrastructure assets. So to start with, well, about GRESB, what is GRESB? First of all, the mission of GRESB was to accelerate the transition to sustainable real assets. And how do we do so? Well, GRESB has been at the core and very founding of setting up the standards for infrastructure as an industry around ESG practices and collecting ESG data. And we do that by, first of all, feeding into the standard the GRESB assessments, which are basically what we could call, in a very simplified term, questionnaires that managers and asset operators, for instance, can go and complete in an assessment format, providing all their ESG data, both in a qualitative form and in a quantitative form as well. Then GRESB, of course, validates this kind of information. We set scores, we provide benchmarking information, as well as peer grouping information that is used on one side by these portfolio and assets, as we can see from these slides, and on the other side by the actual institutional investors that can then either look at how these portfolio companies or investments compare across each other when it comes to benchmarking and peer grouping information, or can actually extract the data itself, the ESG data, to have a look at it and perform additional external analysis. But how are these assessments structured? So what we see in the next slide here, well, first of all, GRESB captures two different types of assessments, one at the fund level, mirroring and looking at infrastructure funds, and one at the asset level. The one at the fund level is a comprehensive of two main components, how we call them at GRESB. And that's, first one, there is the management component. The management component basically collects qualitative information when it comes to ESG data. Information such as policies, risk assessment, risk management practices, but also stakeholder engagement, for instance, and leadership indicators. Then there is a second component, which is called the performance component. This is basically an aggregate of all the portfolio companies' information of a fund. So, for instance, in this case, well, if there is a fund, all the assets, the portfolio companies of this fund will have to perform an infrastructure asset assessment, and then this information is aggregated at the fund level. And again, also for these assets, there are two main components. One is on qualitative information, and the other one is on quantitative information. So this double approach to collect ESG data. When it comes to coverage, who is then using this type of data? Well, we saw before that GRESB is used by both assets and managers, so asset operators and manager, but also by investors. Here we do see that in 2022, over 170 institutional investors use GRESB data for over 50 trillion of assets under management in terms of USD. When it comes then at the participations, so at infrastructure assets, we do see in 2022 over 650 assets reporting to GRESB for over 160 funds. That's actually an increase of 16% compared to the previous year. And now GRESB infrastructure covers over 1.7 trillion of gross asset value. But what does GRESB stand for? Well, GRESB stands for the global, at the beginning, real estate sustainability benchmark, that now, of course, evolve into capturing infrastructure. And here in the next slide, we can see the breakdown when it comes to looking at the region. So at the asset level, we can see that the majority of the assets come still from Europe. They represent roughly 50% of the benchmark at the asset level. Then we have American assets, mainly coming from the US, Canada, but also Central America, such as Mexico, and Latin America, such as Brazil. Then we do see assets coming from Oceania, mainly Australia. And then we have a big increase when it comes to Asian assets. Actually, Asia is the benchmark and the country and the region, that is growing the most, with two main countries driving this growth, namely South Korea and India. And we will see later what are the implications of this. For the fund, we do see a very similar picture. In fact, also at the fund level, the biggest majority of the funds comes from Europe. And of course, then there are globally diversified funds that represent the other half of it. And then there are a few Americans, Asians, and Oceanians funds as well. But now moving towards performances. First, we look at the data coverage. The data coverage is basically the amount of participants that are able to report and collect certain metrics out of the overall benchmark. What we do see in this graph is a comparison between the past 2 years. And actually, we see improvements across the board for the majority of the metrics. There is perhaps one metric that stands out and one indicator that stands out. That's the certifications and awards, where the coverage are still fairly low compared to the rest. That's partially because obtaining certification in infrastructure is no easy task. They are costly, both in terms of economic value, but also in terms of resources. So we do know that especially assets that are starting to approach ESG now take some time to provide and collect this information. When we then look at the scores evolution, the GRESB scores are indeed a comprehensive of the two components introduced before, so the management and the performance component. We actually do see improvements for the past 4 years, both at the asset and the fund level, where now assets have an average GRESB score of 79 points and funds an 82. These metrics and percentage points are obviously out of 100. Then looking at the region again, what we see actually is that the majority of the regions at the aggregate level tend to perform in a very similar way. We do see globally diversified that actually are a sort of leader when it comes to the regions. That's very much because of the sample bias situation, where we have only very few globally diversified assets, whereas the majority of the assets come from specific region, obviously. In fact, when we look at Europe, Oceania, and America, we do see averages that tend to be similar. What we do see also, though, it's Asia seems to be lagging behind when it comes to having ESG performances of a certain level. That's perhaps is partially due to the fact that Asia, as we said before, is actually growing a lot. And it means this, that normally assets that are just getting started to ESG practices tend to have, of course, lower performance. And that's what we also looked at in this presentation. We look at the correlation of years of participation and engagement with ESG, or sustainability more in general, at GRESB, and the final ESG performances and scores. And in this graph, you can see that participants that have been reporting to GRESB and engaging with ESG practices for at least 6 consecutive years tend to, on average, outperform those that are just arrived to the benchmark, so those newcomers. And this actually what could be expected and partially explains the ages lacking behind compared to the other regions. Then, almost to conclude, we do have an overview of the GRESB performance scores So how scores improved compared to the previous year? Before we look at the data coverage, now we actually look at the actual results. And we do see improvements across the board for almost all the metrics, and especially for metrics that are deemed relevant by the industry such as energy, GHG emissions, air pollution, and biodiversity and habitat, for instance, also coming out the new TNFD regulations in March. And lastly, to conclude with the very last piece of information, this is an analysis that GRESB conducted in 2022, looking mainly at GHG emission data. And actually part of this information and data itself has been used by GRESB and the Global Infrastructure Hub to produce the 2022 ESG Monitor Report. What we do see in this graph quite intuitively is that assets tend to report more and more on scope 1, 2, and 3, so direct and indirect emissions. That's true in absolute terms, but also in relative terms when we look at a benchmark that is growing constantly. In fact, in 2022, we had almost half of the benchmark that was able to report on greenhouse gas emissions targets. And 40% of those were reporting GHG targets, mainly for the year set between 2040 and 2050, with an additional small aggregates of an 8% of participants that were able to set targets of zero emissions, to set targets that are greenhouse gas emissions of zero. So we do see quite some improvements and at least a more mature ESG approach when it comes to infrastructure assets. Thank you so much. And I will bring back the words to Joss to introduce you our panelists for the following session.
Thank you, Fabio. I think that presentation gave us a great overview and background to the data we collect at GRESB and the trends we see as well year to year. And it really helps set the scene for the next presentation, which will dive into a lot more detail on how the Global Infrastructure Hub have used some of the data that GRESB collect to help produce their monitor report. And so today I'm really pleased to say we will get a lot more information on that report from Henry Blass, who's the Chief Content Officer at the Global Infrastructure Hub. So without any further delay, I will pass over to Henry.
Thank you. I hope you can hear me. So I've quite a few slides. Try to keep on time as much as possible. Before I get on to the ESG, the new ESG session that we've developed in collaboration with GRESB this year. We also had one last year. I'm just gonna take some time to just get an overview of what the monitor does. So as a global infrastructure hub, we advise and we work with governments around the world, G20 governments, on infrastructure finance related matters. And one of the key function that we play is sort of gather with partners key data around those those key trends. So I'm just going to share a few of them. Everything we do is sort of public good, and so you're very much free to go on the website and you get the full monitor report. And soon enough, the ESG session will also be available on that website. So very briefly, I'm just going to go through some of the highlights, some of the partnerships also that we have in that report. The first one is obviously on trends, overall volume. So here, that data is actually developed in collaboration with IG Global. We do some work on that data, but that's where it's coming from. And what it kind of shows is that when we look at sort of infrastructure projects, the volume of private finance has not really increased. So here I want to be clear that we're not capturing the full private investments. I mean, those are sort of plugged in. Bloomberg, etc. I know that renewables in particular is much higher, but IG is one of the few databases that actually cover all the different sectors. And unfortunately, we don't have the equivalent of BNF for all the other sectors. So there's still a pretty good view as to what's happening. So the investment is still too low, and unfortunately hasn't sort of grown as much as we would all like to see. I'm going to pass on to the next slide. So here you see the big divide, which again is very similar to what's happening in sort of broader markets. Private investment has actually increased quite a bit in high-income countries, especially into energy transition. I'm going to go back to that. But when it comes to low-income countries, that still remain an issue. And actually, in fact, the previous years, because of various issues, actually that private investment has actually probably sort of come down. So that's the divide is sort of accelerating in a way, and that's obviously one of the key challenges that we're trying to address as the G20 and as the hub. So besides the insights on volumes, we also have looked at performance, which obviously is driving a lot what investors are focusing on. And here, clearly, what we've seen over and over again is that the infrastructure has been quite resilient to shocks in general. You can see the difference between the sort of global equities versus the unlisted infrastructure equities, but also listed infrastructure equities. They have underperformed the overall market, but in terms of resilience, they have been much stronger than equities in general, which again reinforces the fact that infrastructure in general is less risky than other type of investments. The next slide is still talking about performance. So when we look at debt performance, so we looked at equities, we also cover debt. Most of the data is actually coming from Moody's as well. And we can see that historically, infrastructure debt has much lower risk, much higher recovery rate as well than non-infrastructure debt. So we continue to sort of push for better recognition of that in regulatory frameworks. But that's reassuring, and that obviously that has continued as far as we know. Obviously, default data takes a bit of time, but we haven't seen a huge spike in defaults in recent years, despite COVID and the Ukraine war. Let's go next one. We also look at the what we call dry powder, so the amount of capital that is available to be invested in infrastructure. So that includes funds and also projection as to what some of those funds are planning to dig into infrastructure. And here we sort of see what we've heard for quite some time, but it's continue, which is a lot of capital that's very willing to go into infrastructure. One of the key challenges, especially in the emerging market, and that's why we see the volume sort of going down, is the availability of bankable product has always been an issue, but I think more and more so projects that align with the ESG and sort of climate requirements of investors. So that's on dry powder. And last but not least, when we look at the volumes, I think something that I mentioned, obviously we see the increasing appetite on the investor side for green assets. So obviously renewables is at the moment sort of the darling of investors, because that's you kind of limit your transition risk as well in most cases, and there's usually quite a bit of subsidies also from government. So obviously renewables have done very well, but we also see other green type of assets as sort of being the most attractive for investors. So I think that's where that's probably also why you see a lot more investors and asset managers willing to understand and also be able to demonstrate the ESG value of their own assets to increase their value, because that's what investors want, and the data that we see globally sort of confirms that. So that in a nutshell is sort of the non-ESG and non-sort of GRESB related data that we have. Now I'm going to go to the second session, which is the brand new session that we're very happy to have been able to develop with GRESB, in partnership with GRESB. So let's take a bit of time. So I think, some of the trends will probably sort of, we covered a little bit before, but clearly we're seeing in 2022 that the infrastructure is steadily improving in its ESG approach. There are more ESG policy in place, the better manage ESG risk, the better report it as well. And so this improvement was evident across all assets. And what's probably also important is that it's not only the leaders improve, but also laggards as well. So nowadays, it's obviously becoming increasingly difficult to operate in the infrastructure space without having an ESG or sort of carbon disclosure at your hand. That's got a huge impact on the value and the interest of your assets. All right. The next slide is showing that the infrastructure assets they improve the scores across all three pillars, but slightly better on environment and social than governments. And when we look at the environmental indicators, the assets score the highest on energy. I mean, it's not too unsurprising given the focus on renewable energy and the net zero transition. I mean, the energy transition, and among the social indicators, health and safety score highest. So those are kind of like interesting trends, and again, all of them are sort of increasing, which once again demonstrates that more and more asset managers and investors are really looking at that as in the decision making. All right. Okay, so when we compare that to so we looked at Preqin, so it's not only, I think, GRESB sort of data showing it. Even if we look at sort of other sort of data provider, we can see the infrastructure actually has done pretty well. If you look at all the alternative asset classes, infrastructure is the most transparent in its ESG disclosure. A lot of that obviously is driven by the energy sector, where the focus is massive at the moment. But still, it's reassuring to see that infrastructure players are sort of taking ESG and sort of climate transition very seriously. And the next slide is now talking probably on the sort of the downside. I mean, the things that are yet to be addressed. So infrastructure assets are getting better at. So we're starting on the ESG side. So ESG, I think we can say it's sort of mostly tick the box at the moment. I think when it comes to carbon disclosure, it's getting there, and we'll see later on transition plan. But first, on sort of disclosure of ESG emission targets, we still have less than half that have such targets, and very few of them are actually zero targets. So the good thing, though, is I think that the previous presentation highlighted more and more assets and portfolio and funds are able to report on scope 1, 2, and 3. Which wasn't the case just a few years ago. And I think that will sort of pave the way for, you first have to understand obviously the emissions before you can actually set targets and set transition plans. So I think it's just, I think we see that as an evolution. So first, investors started with ESG, then they started sort of really looking at sort of climate disclosure, and now they're sort of looking at the future plans and net zero targets. So still very, on the right track, I would say. The next slide, just confirming that very few infrastructure assets that has a short-term zero target, and very, very few made it. Again, it's a work in progress. It's hard to change an infrastructure asset. It takes quite a bit of investment and quite a bit of time, but I think it's still it's still sort of again work in progress and sort of very interesting data when it comes to the entire market. So now we. Okay, yeah. Now we move on to, I think, one of the key challenges, which is we kind of need to, infrastructure sector needs to move, and not only infrastructure sector, I think the whole economy probably need to move to capture more outcomes on infrastructure assets. That's still one of the key challenge. It's good. All the evolution has been great on sort of ESG disclosure, etc. But I think we need to start measuring outcomes and better understand how those investments will actually deliver those outcomes. And that data there, obviously, is still a bit missing. It's still emergent. But again, as I say, it's not only for infrastructure. I think it's the overall market. So why is that? Why is that important? So when we look at the plans of G20 countries, and really for on the investor side, there's really a massive pipeline of projects that will sort of come and be invested in or co-invested in by the public sector. Here, what we've done last year is sort of go through 200 plans. We looked at all the G20 plans on infrastructure. And what we realized is that the amount of investment that was predicted or envisaged by those countries in order mostly to achieve their energy transition, but also to achieve the SDG, etc., was actually very, very, very much massive. And I think it's very critical that those new assets are using right away the right framework to better understand how they're going to contribute to the outcomes and make sure that we get the infrastructure that we all want. And finally, last slide. Sorry, my computer was stuck a little bit, but hopefully you see the you see the last slide, where we did as well last year, we've started tracking all the government spend on infrastructure. So we looked at there's 25 countries overall in G20, including the guest, and so we've summarized all their sort of budget for 2022, and we're doing the same thing for 2023 this year. What's interesting is that we see more and more, obviously, of investments in what we call ESG-related outcomes. Obviously, energy transition, but more and more so inclusivity and even more so resilience as well. So clearly, those outcomes are becoming a key focus for the governments, which again demonstrated how important that data work and sort of continue to upgrade and improve that framework is, both from the government side and from the investor side. And that's it. Thank you.
Thank you, Henry. It's great to hear about the wider monitor report and also how the analysts at GIH have combined the GRESB data to display some specific insights on ESG. I mean, I think it's clear there's some very positive trends at the global level in terms of investment, record levels of green investment, and looking at the GRESB data as well, we can see ESG performance is tracking upwards. But there still are huge challenges in place. We know those levels of investment are still below where they need to be if we're going to achieve our sustainability goals. And even if you look down at the ESG level, there's still uncertainty around setting ESG strategies around key areas like net zero, for example. We see that many assets are still unable to set net zero targets at this stage. And that's something GRESB are working really hard on this year directly with industry partners. So with that in mind, I'm pleased to say we do have industry experts here with us present today, and we will be discussing these issues in a bit more detail. So we're going to move on to the panel session of the event. Please, during the panel session, if you do have questions you would like to see addressed, we will see if we can find the time to answer them during the session. And if there are any follow-ups afterwards, the GRESB team will also do our best to get back to you. So in terms of the panel, I would like to introduce them in turn. So I will let them introduce themselves, and I'll pass over first of all to Gioia.
Hello, good morning, everyone. I'm Gioia Torresi, Director Asset Management at CBRE IM Private Infrastructure and the ESG lead for the private infrastructure business. I will pass it to Shali.
Hello, everyone. Shali Lingaratnam, Head of Investment Stewardship at Victorian Funds Management Corporation. We're a $70 billion fund based in Victoria, Australia. I'll pass it over to Rory.
Hi, hello everyone. Great to be part of this today. Really interesting content so far. So I'm Rory Revel. I am Head of Sustainability for Infrastructure at Aberdeen. We focus on long-term investors in small to medium diversified infrastructure assets across energy, digital, transport, focusing on UK and Europe. We generally take a majority position, always on the board, so can really get into the nitty-gritty of delivering net zero practically in these assets. So yeah, really looking forward to this discussion.
Great. And I'm also pleased to say that Henry will join us again for the panel discussion as well. And actually, given the remit of GIH and their role in helping to influence policy and decision-making around infrastructure, we thought it might be first to get into this topic and explore that a bit more specifically in relation to ESG reporting and data. So I would like to kick off the panel discussion today with a question to Shali. In your opinion, how should and how can governments influence the future of sustainable investment in infrastructure so that those investments can have a measurable positive impact and help achieve major goals we're looking towards, such as net zero?
Thanks, Josh. So I guess if we go to the fundamentals, the role of public policy is really to be the instrument which dictates how public resources are deployed to incentivize investment and develop critical infrastructure. And infrastructure by nature are often long duration assets. And when you think about valuing that economic life of those assets, having that certainty of cash flows is fundamental. And so I guess in that instance, having policy transparency and having certainty of cash flows is really fundamental. So I think, there's a couple of things that are really important to attract capital to really support net zero and decarbonisation from a policy design perspective. We know that it's a 3 trillion opportunity. And so a couple of measures that you could look at from a policy design perspective could be legislation, penalties or taxes to really divert capital away from the higher emitting industries. And then the second is sort of looking at subsidies or tax benefits to really incentivise further investments towards renewables and lower emitting assets. I think the IRA and the Repower EU, and I'm sure my colleagues on this panel will speak a little bit more to it, are really good examples of setting that sort of intentional policy framework to sort of support and attract investment into renewable energy and also provide some economic certainty to market participants. I think the other aspect of policy design is not to limit the scope to just supporting the assets themselves, but rather the whole ecosystem. So really looking at planning, permit and supply chains in which they operate in to ensure that capital can flow through the system in a really efficient manner.
Thanks, Shally. Rory, would you like to follow up on any of that as well?
Yeah, delighted to. I think we're at risk of aggressive agreement on a lot of this. I'll try and mix up the perspective a little bit. I think what I'll do just to start with is zoom out just a little bit, just to focus on the really important role of infrastructure in the transition. And using UK as an example, infrastructure-related emissions actually make up well over half of the economy's emissions. 41% of UK's emissions are from the use of infrastructure. So infrastructure's role here is actually in improving the carbon intensity of everyone's day-to-day activities, whether that's the consumption of energy, water, management of waste, consumption of data, etc. So the role of policymakers in this is to create the conditions to make those solutions investable. And at the risk of stating that the very obvious, you can't have this transition to net zero without major improvement in the emissions intensity of infrastructure in economies. As Shally's already said, these are big construction lead times, long lifetimes. Investors need certainty, need a framework that can deliver on them long-term cash flows and support the returns of our investors. And I think, like's already been mentioned, we have seen some really important and successful policy interventions in this space. Again, looking at the UK, huge improvements in the energy intensity of power supply and carbon intensity of power supply, for example, and similar improvements in waste management, whether it's through CFDs, the FIT regime, renewable heat incentive, really successful. But it's not been successful in every sector. Things like transport are certainly lagging behind, and we could do with equivalent policy intervention there. I think that the final point I'll make here before handing over to others is really around the importance for policymakers not to just focus on the big, the high-profile projects that have a lot of political capital associated with them, those big tempting silver bullets. It's really the importance of focusing on the whole system, the grid infrastructure, as Shally's mentioned, unblocking some of this, the permitting delays, planning delays, and focusing on the whole system design and giving a framework for that. Renewables deployment's been great, but we need the system to sit around that to fully support the decarbonisation of the full economy. And that's something that's come out strongly in a recent report, I think, from the National Audit Office in the UK, which has criticised the government's approach in that respect and pointed to the need for a much more holistic long-term view to unlock this kind of infrastructure investment gap that we're all aware of.
Thanks, Rory. Yeah, and it's great to hear the perspective on the projects that have been successful, particularly at the national level, and the proof that this can be done. Sort of zooming out a little bit and looking at maybe the broader collective action by governments as well as an important step in this process, not only at the national level. Initiatives like the G20, GIH work with closely, and even things like global events and the influence they have. Joy, I wonder if you could comment on that and the importance of the collective action as well as the national action.
Yeah, surely. I think that those initiatives have a role, at least in terms of fostering the international climate debate and setting international climate politics on a common trajectory to address systemic challenges. So especially looking at COP, I think that, that is a great initiative in setting the ambition, but then we would expect governments to decline such ambition into pragmatic action-focused policies. So touching on what Charlie and Barry just said, obviously I 100% agree. I think there's, a need for governments to focus on the risk in decarbonization and making it investable to a broad range of investors. So yes, incentives, subsidies, addressing the technology risk, the revenue model risk, so on and so forth. But I think that if we look at maybe more mature technologies, more mature economies, we operate within regulatory frameworks that are set by governments. So we would expect them to role model the change they want to see and they want to get our support on. And I think that here the action should really be a coordinated definition of standards, regulations, however you want to call them, that are very practical and action focused. So I'm thinking all buses and ferries will need to be zero emissions by 2025. All materials to be used in the repair and maintenance of toll roads need to be recycled. Or, creating demand for hydrogen. If governments do that and the action is coordinated, there is no space for climate arbitrage or, outsourcing of emissions or those initiatives that actually hinder the unlocking of that positive measurable impact. And so with COP setting the direction of travel, I would expect the G20 to address this action-focused aspect of it.
Thanks, Joya. And I think what would be interesting to hear from you, Henry, is those points that Joya mentioned. There's a big shopping list of things that the world needs, and we need greater collaboration and coordination at that level. As an organization working to help, I suppose, assist in that process, have you got any insights into what works well and what is proving successful in terms of creating this certainty for the investment landscape?
Yeah, thanks. I'm going to try to represent, I think, all the G20 governments, which I really don't. But just to give some insights. First of all, I think we have to recognize that for governments, the ask is big. So they made all the commitment at COP, last COP. One before last COP, which was courageous. I think we also have to realize that, yes, they have to create incentives to scale things that we know works, just such as renewables, etc. That has worked. It takes time, but that has worked. But also at the same time addressing, I think, some of the more vexing issues around sectors for which we have probably yet to find the actual technology that actually works. And I think that de-risking of taking risk when it comes to this technology is a key thing. If you look at what happened in a few countries and a few continents, again looking at solar, etc., that was absolutely critical in enabling where we are now and sort of being able to sort of scale up that technology. So governments are sort of, I think, they have to address both. They have to help scaling. They have to then, they have to sort of de-risk the solution. They have to help scaling, and probably what we want to talk more about is that after that, getting the entire private sector and the entire economy actually to really focus on those solutions that we want to implement. And that's where the role of regulation is critical. But I also kind of wanted to sort of highlight that it is not that simple. We reviewed all the plans of all the G20 countries, realized that actually less than 25% of those plans actually had any clue as to how much the actions that they were proposing were going to cost. And also a lot of them were not clear about which technology will need to be implemented. So I think there's huge amount of work still required there. Now, when it comes to regulation, it's no surprise that when you look at the ESG score and where we looked also at the sort of volumes, Europe in general, so I include UK still as part of Europe in this one, instead of being kind of the the champion of renewables and has done very, very well. The regulations there definitely accelerated things quite a lot. I mean, we see investors there. They could feel that regulation was coming. It's coming from different angles. I think it's still, even in Europe, quite hard sometimes to understand which one is sort of driving, the driving force. But clearly, I think that those regulations really at least sort of force any investors to look very carefully at their portfolio and really start thinking, how do I get that portfolio to, how do I get to reduce my climate risk, but probably more importantly, more and more the transition risk of my portfolio. And so clearly, those regulations have had an impact. Now, when I look at globally, I think it's going to be hard to get those regulations to be completely aligned right away. I mean, the ISSB that was created 2 years ago by the G20 is a good example on the ESG side and disclosures. It's a good start. When it comes to transition plan and taxonomies, etc., it's a lot harder. There's obviously a lot of different type of countries, and for emerging countries in particular, it is there's that fear that they're going to be forced into technologies and solutions that they cannot just afford at a time where they still need to address a lot of the basic SDGs. And so I think we have to kind of recognize this reality and sort of try to advance the best practice, demonstrate it in sort of more advanced economies. But again, that still has an impact on emerging markets because you de-risk these technologies, and you de-risk the solution and making them cheaper. So sorry, there was a long summary, but that's roughly I think where we are when it comes to the G20 and sort of a regulatory aspect related to ESG.
No, that's very interesting to hear, Henry, and I think you move us on well in terms of thinking past the higher policy level and collaboration on that front down to actually ESG and the practical level and the challenges people face with reporting and consistency on a day-to-day basis in the jobs we do. So I thank the panel again for the insights at the policy level. If we now start to think about ESG reporting and making progress on things like convergence and interoperability for ESG frameworks, what do you think measures groups can take, like the G20? And Henry's touched on a few. So maybe Joy, I'll pass on to you for a few thoughts on that as well.
Yeah. So, I mean, we have said it, there is very strong political support for net zero, obviously, but also for other interconnected challenges, including natural capital management, human rights, and the likes. But once again, if we go beyond that aspirational level, I think that the efforts have been really, really fragmented, especially so on the reporting and measurement side, where the initiative has been very often private or investor-led, and international climate politics has failed so far to deliver a cohesive reform towards convergence. And I'm thinking at this as a key pillar of that aspect of driving ambition into action and yielding that measurable positive impact we're all after. Looking at Europe, I think that Europe has been quite successful in legislating on ESG frameworks. I think that all of us who had to go through SFDR appreciated the role that it at least had on reviewing policies, reviewing our frameworks, making sure they are set to deliver sustainable outcomes, and probably those will follow in coming years. But once SFDR was included, the UK announced SDR, which is similar, but not really. The same is happening with TCFD and other equivalent climate-related disclosures in other jurisdictions, which are all broadly similar, but not really. And what that means for global or OECD investors is, double, triple, if not more, regulatory risk, in addition to an ever-increasing reporting burden, which in my view dilutes the efforts and it's ultimately counterproductive. I think that also in this area, we need intergovernmental collaboration. We need agreement on a global baseline of ESG material matters. Everyone reports on, so that is sector agnostic. It is quantitative enough to speak to investment and asset management teams, where, in my view, the key agents of change, they would be driving those sustainable investment strategies supported by sustainability and ESG teams. And I think that is really the goal, the G20, or whoever takes on this big, huge challenge should have in mind.
Thanks, Joya. And you mentioned some specifics there, particularly around SFDR. We know this is the first year that's coming into play, and it will be fascinating to see how successful or otherwise that is in achieving some of those goals. Might be interesting, Rory, to pass to you on some thoughts on that. How are you seeing SFDR's efforts in promoting interoperability? Are you seeing that as a burden, or are you seeing that as tackling some of the challenges that Joy has mentioned?
Yeah, look, I mean, I think many of us on this call have had to get to grips with SFDR and other related frameworks over the last couple of years, and it's by no means been straightforward. I don't want to spend too much time bashing all of that. I think it's hugely important to have this standardized way of discussing what good looks like for investments, and some of the developments that have come out of SFDR have been hugely important in promoting that. But I think if we're speaking particularly about direct real assets, even just real assets, infrastructure in particular, it's a natural home for net zero. It's a natural home for sustainability and ESG. If we're honest, as we discussed earlier, it's the key to enabling a lot of this change that needs to happen in society. And I think there is an inherent challenge in creating a disclosure framework, a reporting framework that is completely agnostic to all forms of investment in all places. And I think there are well-known challenges with the practicalities of SFDR, particularly in the context of liquid asset classes. And I think we're seeing that in the real estate sector as well, with some of the commentary coming out of INREV and other industry groups at the moment. So hopefully that'll change over time. We can build on this and learn. We're quite early here. Like, the important thing for me is do these help us make better decisions about sustainable investments? Do they help us better understand transition risk and act on it? And I think I'm very aware of disclosure for disclosure's sake at the moment, and these metrics have really got to ultimately support better understanding and better decision making. I think one area where we're seeing quite useful convergence is on carbon metrics. Again, I don't want to go down the rabbit hole here, but PCAF's introduced obviously this relatively common language, which is finding its way into TCFD and into SFDR. So we're getting this way of understanding absolute and intensity-based emissions in a way that is broadly comparable within sectors. So as I say, there are challenges, but I think we're on the right path broadly.
Excellent. Yeah, and I think that is key, really, isn't it? That if this can result in practically better decision making and helping with sustainability plans and achieving goals, that's where we're going to see the proof. So I guess it will be some time before we know specifically with SFDR the impacts, and we'll be keeping an eye on it. And it's something GRESB are taking a huge interest in terms of how those metrics are influential and how that influences our own products and services as well. Thinking about plans in general, Shally, I wonder if, from your perspective, how are these things affecting your strategies and having a practical impact on your day-to-day work as well?
Yeah, so I mean, I guess echoing the comments from the panelists before, even though there are obviously a lot of either conflicts between a lot of these metric regimes or there's overlap, and it obviously creates much more of an administrative burden for practitioners. One of the good things that is coming out of it is that you can only manage what you can measure. And so using that as a starting point and really leveraging that for engagement. And so we have to understand that a lot of this is point-in-time analysis and point-in-time data, and really what is important is to actually look at things like the delta of those metrics over a period of time, and then look at what the forward-looking positioning is of these assets to really work out how they're going to be positioned in different scenarios, whether that could be through physical risk events or climate risk events, or a range of policy, I guess, transition risk-related events. And so we certainly use it from the perspective of how do we now engage with the infrastructure managers themselves and the policymakers in which the infrastructure assets are located to understand what the trajectory is and what that sort of latent risk is for us as an investor.
Thanks, Shelley. Joy, maybe going back to you to close off this question, how are you seeing that this impacts your own strategy and your investment plans as well?
So, I mean, I'm thinking that SFDR, which is probably the latest framework I've been closely working on. I think that, I see it as a very positive initiative. The work that all of us had to do in refining our plans is surely a very important step towards the results we want to yield. And I think that, we probably need to work at something that is more, in my view, quantitative, because I think that you cannot manage what you cannot measure. And, we don't know yet if SFDR's decision useful enough. But, I think that those initiatives are positive, and I think that, will drive a step up for now in terms of strategies, hopefully also in terms of results.
Thanks, Joya. Moving on to sort of getting even more specific, I guess we've covered the broad policy level, we've covered looking at ESG strategy and the impact of things like SFDR, at the fund level. I think where this has a practical impact is the day-to-day impact on things at the asset level as well, and it'd be interesting to explore that a little bit. And our data is based right from the asset level upwards, so it'd be interesting to explore this topic and how we think that these new frameworks or new approaches are having an impact at the asset level and actually having a practical impact in the real world. And one way is, again, this navigation of the number of tools and frameworks that are out there to help set strategies for net zero and how that impacts at the asset level. So, Henry, maybe over to you to discuss that one and kick us off.
Sure. So I think, to be honest, the asset level is something that has been a lot less discussed. I think sort of multilateral tables. I think the focus has really kind of been sort of a high level. That being said, I think that's for me really the asset level is where I think that the change eventually will happen. And I think we're seeing probably two different approaches there when it comes to infrastructure. One, which has been to sort of go all the way on one metric, and that metric has been carbon. The beauty with carbon, as we all know, is that it adds up. It's so on the few aspects where we have this almost like mathematical, truth, in a way, and comparability across different regions. And so one of the Sustainable Finance Working Group approach has to really try to understand how we could, I guess, solve carbon not before, but as a way to understand how we could solve the other aspects. So I think there's been, and you've probably heard, there's a lot of initiative, not necessarily G20 related, a lot of that's driven by countries or private sector, sort of trying to create the frameworks at the asset level. Net zero data public utility that's going to be created as one of the example, but really sort of focus mainly on carbon and trying to sort of solve like not only what you intend to do, but also what are the plans and make sure that those plans are being implemented and actually delivered. So that's one aspect. The other aspect is more towards the financial markets, and has been to try to develop labels for assets that will tick the right boxes in order to make sustainable infrastructure assets more liquid assets, especially for long-term investors that unfortunately don't necessarily have the time to sort of look at each asset in particular, but are very much willing to enter and to sort of finance, I think, that energy transition and sustainability in general. So we have got a few labels that sort of popping up here and there. Some driven by MDBs, because I think one of the key issues is really, especially in emerging markets. But at the moment, we have yet to see sort of a clear, I think, winner for this. But I think that will go a long way, especially again, I'm talking about emerging markets, a long way into enabling long-term investors to sort of show more interest, I think, or be more certain of the impact of some investment in those markets that may be far away from the market they used to. I think so. Really, to approach one is much more detailed, but at the moment, sort of use some carbons, and the more general one, trying to sort of put the label to facilitate those type of investments.
Thanks, Henry. Yeah, and I think one specific area around this and one challenge that you've touched on is, and actually the panel's mentioned a lot, is net zero. And we've even had a question around the challenges, a question from the audience around the challenges of setting a net zero target. Rooney, I wonder if you could comment on the frameworks around that emerging net zero topic for infrastructure, and any that are commonly used, and any practical insights from your work.
Absolutely. So I think, I mean, for me, day to day, and the assets we manage, this is so very much inherently material, commercially material to how we run the assets. So naturally, it's something that we think about very practically every day, and have strategies to respond to, whether that's increasing biogas share in a fuel mix, or running heat networks off renewable fuels, or diversifying into energy services businesses. It's opportunities and not just risks. There's various tools emerging within the infrastructure space to support our understanding of all of this. Really, that's built on a foundation of just good greenhouse gas accounting in the first instance, proper inventories, scope 1, 2, 3. Let's get the data right so that we know what we're working with. Back to the can't manage what you don't measure. I always point to on this the PAS 2080 standard, which I was sort of loosely involved with authoring back in 2014, which really sets the framework for how you understand the carbon impact of an infrastructure asset and manage it through its life cycle, parties involved, roles, responsibilities, how you set targets, all of that. So that's really, really useful. And we're starting to see elements of that come through now in the IIGCC Net Zero Investment Framework, which is shortly, I understand, to be published, which really for the first time for infrastructure gives us this framework. We can have common rules around, well, what does aligned with net zero mean? What does aligning with net zero mean? So that there's some lens for people to use to compare assets with each other. I think that's a really useful development. It's to some degree quite challenging in infrastructure, given the heterogeneous nature of this asset class. Can you compare a train with a run of the river hydro asset with a fuel pipeline? Challenging. So it needs to be high level enough, but allow us to really understand, well, how do we move towards net zero? Some assets are just inherently linked with this, aren't they? A renewables asset. So the balance of focusing on scope 1, 2, and 3 will be quite different for different assets.
Absolutely, and you highlight a very relevant GRESB challenge, and that's something we were working on this year, is getting industry together across sectors and trying to understand where the relevant points of these various existing net zero frameworks are, and we're going to really push towards coming to some consistency, hopefully, towards the end of this year on that. And it's a big project for GRESB this year. I know we're quickly running out of time, so I wanted to quickly put anything back to the panel in general to see if there's any final messages you'd like to give, or summing up to the panel in general. So it's an open call back to the panel if there's any other points you would like to add. Covered everything. We've solved all the problems. We can move on. I can shut down my computer for the day. Okay, that's great. Well, without any other messages, I think we've had a few interesting questions come in. I hope we've managed to respond to you live during the panel as well. So thanks for those insights. And some of the questions you posed did help steer the conversation, which was great. I would like to thank the panel one more time for their excellent insights today, and also like to thank Fabio also for your presentation as well at the start. And also the GRESB events team behind the scenes as well. They do a lot to help make these events work really well on time. So with that, look out for the report. It's coming out on the 15th of March, and we will share the materials with you then in regards to this panel discussion as well. So you can watch again at your leisure and take in the insights once more. So with that, thanks everyone, and have a great rest of the day.
Thank you. Bye.
Thank you.
Thank you.